Hi, everyone. I am Jonah. I am head of marketing and business development for Metis. It is a pleasure to have you here for our weekly live stream. Every Tuesday at 4 p.m. UTC, we host a live stream. And during the months of October and November, of course, it's related to our hackathon, the $1 million Metis hackathon, which we're very excited about. We've had hundreds of developers sign up. They're building all kinds of cool dApps in the realms of DeFi and NFT and gaming and Web3 and Web2, probably Web25 somewhere. And it's really cool. We're going to have a special guest today as well to give a talk, as is our custom during the hackathon. What I'm going to do is I'm going to share screen, and hopefully this will work. And yeah, and then we'll get you going on our little presentation. So here we go. Work. Okay. And hopefully this will work as well. Okay. Their screen is loading. There you go. Okay, so hopefully everybody can see this. If I'm not hearing from my colleagues, it means that you can see this, so we're good to go. So we're Metis. We are a layer 2 Ethereum scaling solution, and ultimately we're building the hub for the entire Web3 economy. This will all be explained in time. Right now, I'm just going to give a brief intro about the hackathon. We'll bring in our guest. The format after that will be Q&A, and we'll go from there. So the Metis hackathon is October 2nd to November 30th, as mentioned. Building a sustainable new world on Web3. Hackathon.metis.io is our website. So you can get involved in multiple different ways, right? One way is if you're a Solidity developer and you want to build a dApp on Metis Layer 2, you can do so. All the information at our website. And also if you're a project, whether it's a Web3 project, blockchain project, or Web2 project you want to sponsor, you want to put speakers in, we're going to have a great speaker today, same kind of thing, judging, all that good stuff, you could do so there. All the forums are available at hackathon.metis.io. Our agenda for today will be that we have our intro about Metis, which I'm doing right now. Our speech will be Stefan Loesch from IDCAP. He's the CEO of IDCAP, and he'll be talking about regulation of crypto assets. We'll have him in very shortly. Hackathon details will come after that. And, the order is reversed. Q&A for Stefan will come right after that. And then after that, we will bid Stefan adieu. And we will talk more about the hackathon. And you'll be able to ask questions directly of Metis after that. First round of Q&A is designed more for Stefan, somewhat for Metis. And then at the end, we'll have more questions about Metis. As all of you know, I'm sure we're getting close to our Andromeda mainnet launch, which we're very excited about. Lots of good stuff. Anything that I'm able to answer, I will certainly try to answer. And of course, we've got some other team members here. Colleague Pavel is there, Shada, Irina. We've got some of the superstars of the team on the chat as well. Metis Hackathon, here's more information. As you can see, all these messages coming up on my screen. Metis Hackathon is hackathon.metis.io. And yeah, October 2nd to November 30th. $1 million hackathon. I really can't stress enough how big a deal that is. Listen, there are some projects much larger than we are, or we have been, and they did not deliver $1 million Metis hackathon, certainly. So we're pretty excited about the size of the prizes that are available in this event. And it's really just designed to bring in great Ethereum developers, great Solidity developers. If you're not a Solidity developer, rather, and you have an idea, you are always welcome to team up with a friend or an associate or whatever who is a developer. So we want to get all kinds of great ideas in there. We understand that not everybody is a Solidity developer. As long as you have someone from your team who can truly build an Ethereum dApp or migrate one, that's essentially what we're looking for. And here's the Metis Hackathon. So as I mentioned, our special guest will be Stefan Loesch. He will be coming on shortly. He's the CEO of IDCAP, and he will be talking about the regulation of crypto assets in just a moment. I want to briefly give the rest of the hackathon information. Here is our Discord. I'm going to give you a second. That's our QR code for our Discord group. Our Discord group is very relevant. We have day-to-day conversations about Metis and news and so forth. But in addition to that, that is a place where developers can gather and they can ask questions during the hackathon. What's going on? Hey, can you look at this thing? Whatever. We provide feedback constantly. In fact, we encourage developers to submit early, not on November 30th, submit tomorrow, because that way we can give you feedback and say, hey, maybe fix this, do this, whatever. It's like a cheat code. It gives you kind of multiple bites at the apple, multiple chances to get it right. And our Discord community manager, his name is David. He is a fantastic human being and really, really good at his job. He's patient. He's lovely. He will be there to help you. Our Telegram group also has some information. You can see it there. It's Metis DAO. Another lovely human being is our community manager on Telegram. That is Norbert. Norbert is supremely helpful. I do drop by from time to time, so do other team members. We've got a Telegram group for Metis DAO traders if you want to deal with the token. We've got communities in Chinese, and rather Mandarin, Hindi, Russian. We're looking towards Spanish, Portuguese, and all that good stuff. So yeah, it's very exciting, and feel free to go to any of those channels. Metis communication again, metis.io is our website, and there is our Telegram group, as I mentioned, t.me/metisdao. Scan the QR code if you like. I will wait a couple seconds, and we will keep going to the next screen. Maybe we'll keep going to the next screen. Hackathon communication, some more of it is hackathon.metis.io. So all our conventions are metis.io, right? So like, for instance, if you wanted to look at our tech documents, that would be docs.metis.io. Hackathon.metis.io represents our hackathon website. You can check out everything there. You can apply to build. You can look at our prize tracks. You can see everything that's going on. Check out a lot of our partner projects too. IDCAP today, but some others involved as well. We really encourage you to see the other projects that are contributing to this. We're very, very pleased to have them on board as partners. We've got some great ones from Latin America that we've been able to recruit. We've got existing strategic partners of Metis that have agreed to join in on the hackathon and all that good stuff. There's the Discord link, as I mentioned. Shout out to David. And finally, for hackathon submissions, you could do so at metis-ethereum.devpost.com. I will give you a couple seconds to scan that QR code if you wish as well. But again, all of these details will be available on the Metis Hackathon website. And finally, submissions so far, wow. Check out that variety. So, okay, you know, that makes sense. You got the United States, you've got China, you got some of the superpowers. How about Bangladesh? How about Peru? How about Zambia? Like, this is great. UAE, we're all over the place. Middle East, Africa. I think we're covered pretty much everywhere except Antarctica. We do encourage, if you're a penguin and have Solidity developer skills, please do, sign up for the hackathon. All right. On that note, I will stop sharing screen, and I will go over to Stefan, and I will introduce him now. Stefan, as I mentioned, is the CEO of IDCAP. He joins us, an esteemed speaker. He'll be talking about regulations in the crypto market. Take it away, Stefan.
Hi. So, well, I hope you can hear me. I have a little bit of a new setup, which is possibly a bit unusual for Zoom, as in I'm now able to share my slides within my own video. So, which also means I don't have a screen share to go. So you might want to have my window in full screen or whatever if you want to see the slides. I slightly changed the talk because I thought I'd focus on something a little bit more precise, especially because of something that happened yesterday. I'm going to talk about decentralized finance and regulations, and there in particular also on stablecoins. So what happened yesterday? So yesterday the Twitter was a bit lit up because President's Working Group had their report on stablecoins. And if you look at Steven's tweet, his point here was that essentially it looks like the President's Working Group suggested stablecoins need a banking license. And this is, as in Oscar's tweet down there, that's a bit of an issue because banking license is pretty harsh. There are 2-3 different models that people could have used that could have been a little bit more lightweight, like an e-money regulation, like a money market fund regulation. If you go full Basel III, this might make life pretty difficult for stablecoins, and it might really be. Yeah, it might be hard on the community because essentially means that stablecoins need to be issued by banks, and well, banks might not have like a massive incentive to issue stablecoins and to make them nice. So this is not a particularly great development in the US. Having said this, in the EU, things are looking generally a bit different. This is not necessarily the same regulation, even though this actually comes from a Basel recommendation. So we need to see where this is going. But anyway, so what I want to talk about here then is generally I'm talking about well, I'm not going to talk about traditional finance, but I'm going to talk about decentralized finance, and I'm talking about regulation that applies to the equivalent traditional finance finance areas. And so obviously the areas that we're going to look at is the traditional areas in traditional finance, which is cash. I mean, cash is somewhat trivial in traditional finance, but in DeFi it's not that trivial. Exchanges, which are then AMMs, CFMMs on the decentralized finance side, and banks, which are collateralized lenders, the likes of Maker and Aave and Compound. Having said this, obviously, real world banks, it's not a one-to-one match. Yeah, real world banks do a little bit more than just collateralized lending. Anyway, so in the traditional world, there are key regulations in this area are like your standard AML, KYC, PP, CTF, etc. E-money payment, market infrastructure, fund management regulations, depending if you're talking about stable coins, fund management, and then banking regulations. Before we start, let me do a little bit of advertisement for this, and this is actually where these pages are come from. And you might, if you're a participant in the hackathon, we also sponsored this, and we sponsored it with a few places. We are launching a certification in the crypto asset space. It's going to have 3 levels. So level 1 pilot starts very soon, starts mid-November. First exam is going to be mid-January next year, and it's going to be a live exam. So you need to go somewhere if you want to do that. Syllabus of level 1 is blockchain basics, Ethereum, fungible tokens, NFTs, then important chains and protocols to give a system overview, and intro to regulations. And we feel that this is actually something that really everyone in this space should know. People who come from traditional finance, maybe, well, they know regulations pretty well, but they might not do the other stuff, know the other stuff very well. Whereas people who come from the crypto native area probably need to get used to regulations a little bit more. So just put the URL here where you can contact us for more details if you're interested. Anyway, so jumping right in. So stable coins, and so to the extent the regulator really almost seems to think only about this as stable coins, because there are 3 types of stable coins. And I'll so the first one I'm talking about, that's a collateralized stable coin that is backed by the reference asset. So the reference asset being, let's assume it's US dollar. And so if it's collateralized by the reference asset, essentially means that whoever issues this thing just takes US dollars, puts them in trust, and issues stable coins against this. Most major stable coins are, well, apart from DAI, are organized that way, and even DAI goes that way because DAI is now backed by USDC sometimes. And there tends to be a mechanism of these stable coins that ties the value of the coin to the value of the reference asset, which is essentially you, or at least some people, can possibly redeem it against cash. Now, there are stable coins in the market where there's less easy possible, and there are ones where this is more easily possible. But in theory, that's the issue. And there really you have a one-on-one if you look at the balance sheet. So balance sheet is here, this stuff here. The liabilities and the assets are pretty much the same. It's really a one-to-one backing. Now, the other one is a cross-collateralized stablecoin. And cross-collateralized stablecoin is a stablecoin where the collateral is not US dollar for a US dollar coin. The collateral, like the traditional DAI, where you put a lot of ETH in, and then you have a first loss buffer, and then you issue a stable coin, and effectively this buffer makes sure that there's always enough collateral there, and if there's not enough collateral there, the buffer is going to be liquidated. And finally, algorithmic stablecoins, which are a little bit which are somewhat different. In the sense, you can think about them as cross-collateralized coins that are collateralized with their own protocol asset. Generally, what they're trying to do is they're having it's generally at least two token systems. They have one token that is meant to be stable, and whenever the price is below $1, they buy it against the second token. If the price is above $1, they sell it against this token. And so that's the way of keeping the token in line with $1. Now, obviously, as I say, if we think about the present, banks are not going to issue algorithmic stablecoins, and banks are also probably not going to issue cross-collateralized stablecoins. There's not really a point. This is possibly a fund structure, but there's no need to issue this as a as an algorithmic structure. In fact, if you're a bank, you don't even have to collateralize it with anything, because you can just collateralize it with your own liabilities effectively. So you don't even have to hold the assets in escrow. So that's an interesting development in the stablecoin market, and we need to see where this is going. Now, more generally with the regulation, I wanted to mention two more things. So one, AMMs, which is sort of generally these constant function market makers, which allows to trade tokens directly on the chain. And they're really quite nifty structures, driven by this invariant function, which originally was this k equals x times y. You might have read about this if you look at these things. And there's various variations on this structure. So Balancer, Multipool, Bancor has impermanent loss protection. Curve has tweaked a little bit the curves. Then SushiSwap, Uniswap, Torchain. Uniswap, obviously the big guy on the room, and with Uniswap v3 getting much more into a market making world. So that's quite interesting, because I mean, they are not there in terms of volume where the likes of Coinbase would be, even though it looks like the Uniswap with v3 somehow wants to break a little bit into this market, and from many point of views, Uniswap v3 is closer to Coinbase than it is to Uniswap v2. But again, compliance-wise, this can possibly be a little bit hard, especially if regulators really think about this. Well, let's say if regulators say you need to stable coins can only be issued by a bank, then they might also have views on what AMMs and CFMMs should be. So we need to see where this is going. And then the other thing where you say that the equivalent of banks is effectively our collateralized lending protocols are the compound maker. There's another few ones, a few ones around, but effectively the important thing on these things is they can at the moment not really do what banks do, which is lend you money, lend you unsecured personal loans, these like of things, or mortgage loans. At the moment, this is all on-chain collateralized assets. So the way it works is you deposit, I don't know, $1,000 worth of ETH, and then in MakerDAO, you can get whatever, 500, 600, 700, I don't know what the LC ratios are at the moment. You can get a certain amount of, you can borrow a certain amount of another coin. So with MakerDAO, obviously the way it was done initially. The whole point of MakerDAO is you can borrow. I mean, they issue, but it's kind of a borrowing transaction because you need to give it back if you want to get your over collateralization back. So effectively, you're borrowing a DAI, but this is a freshly issued DAI that you borrow. Likes of Aave and Compound is more like you deposit one asset and you borrow another asset. But again, there is always over collateralization. And if the value of your collateral falls below the value of your of what you've borrowed, then you're going to be liquidated. And so essentially this means they're going to sell the collateral in the market and the loan is repaid, so that there is no loss. The importance of this is that the reason why you need to do it this way is obviously if you're on the blockchain, at least at the moment, it is still pretty hard to do enforcement off chain. So yeah, the biggest lending portfolio of traditional banks is mortgage lending. But obviously the whole point about mortgage lending is that you are able to disclose on the house if you default on the loan. And at the moment, Ethereum or any other blockchain doesn't allow you for that. And the other thing is also that automated credit analysis, depending on the assets, is also a bit hard. So anyway, that is kind of the overview where decentralized finance meets traditional finance. So our stable coins are our cash replacements. Our AMMs, CFMMs are our exchanges, the Robinhoods of the world, and our collateralized lenders are depository institutions. You can put, like in Aave, you put your money there, you can earn some carry on this, you can earn some interest on this, you can borrow, provided you have put collateral. So it's not quite a bank, but it's relatively close to a bank. So regulation. So as I say, we have looked at this and said, okay, that's sort of a traditional financial services equivalent. So what kind of regulations do we have in traditional financial services? And there are 4 major groups, or 3 plus 1, because one is a little bit the odd one out. So the theory with financial services regulation is that you don't need it unless there is a market failure. So, and when the European Union, for example, when they do any regulations, there's generally a market failure statement where they say, we have to do this regulation because markets can't do it for reason X, Y, Z, and this is why they do this regulation. And there's generally also a cost impact analysis. It's like, okay, look, the market failure, is this really justify the cost of regulation that we have there? So that's prudential, market structure, customer protection. I'm going to go through them in a second. But there's a 4th group of regulations, and that's a bit the odd one out. This is the policy support regulation, how I like to call it. And this is these things where banks or the financial sector more generally is used as an extended enforcement arm of the state. There's not really any market failure in this area. It's just because, well, everyone uses the financial system, including criminals. It is actually quite useful that if you plug into the financial system, then this allows you to this allows you essentially to fight crime, to fight terrorism, to find achieve political objectives. And so there on the policy support stuff, the financial services sector is generally co-opted by the governments to do a little bit whatever the general policy objectives are. As I say, AML, KYC, and the KYC comes in 2 lines. So here's like the AML KYC is essentially there. The point is, don't get criminal funds into the financial system. And that's really sort of one of the areas where, especially on the crypto side, because of the anonymity / pseudonymity of the crypto space, where there is a big tension between what regulators want and what the crypto system does, and partially what it does by design. I mean, obviously censorship resistance and all these things, why Bitcoin has a proof of work. This is all has to do with trying to avoid AML to some extent. The other areas that are covered here that are similar is PEP, politically exposed persons. This is about embargoes. Yeah, if you have someone in a country where you're not supposed to do business, famous ones obviously being North Korea, being Iran, then you're supposed to, as a bank, not do business with them, and you need to check that indeed you do not do that. So that's a PEP checks. And CTF, counter-terrorist finance, that's kind of the opposite of AML. AML is about getting criminal funds from the outside system in the regular system, and CTF is funding terrorist activity. So all these things are in the policy support area. And this is really quite important for crypto, because this is really the area where crypto is very different because of its anonymous character. Now, the area of market failure, so that's the three other ones. Prudential is about markets that are safe and robust. And up to the great financial crisis, we only had microprudential regulation, which was about essentially are banks, are asset managers, is market infrastructure, are they safe enough? Are they not going to default? And then they realized that you can have like a whole bunch of banks that look safe, but because of the way they're interconnected, when one faults, this can ripple through the system. And so this is when they added macroprudential regulation, which looks at market infrastructure as a whole. And this also means that nowadays, usually prudential regulation is back at the central bank, because the central bank looks at all kinds of macro things. And so in particular, they also look at macroprudential regulation. Then customer protection regulation. And so this is really about, it's not about all customers, it's about non-professional customers, vulnerable customers, where the regulator feels they need to be protected from cowboys in the market. This means KYC requirements, and these are different KYC requirements. Call them here UYC requirements, understand your customer. So the KYC on the AML side is about make sure they're not criminals. The KYC on the customer protection side is make sure you understand how smart they are, if they're not that smart or not that financially sophisticated, make sure you understand their needs. Possibly you have a fiduciary duty, so you can't just take advantage of them because they did things wrong. Interesting point, for example, you might have seen yesterday, I think, where someone sold an ape for 4 ETH when he wanted to sell it for 4,000 ETH. And this is these kind of things where generally fiduciary duty would probably tell you that a bank needs to protect you against this. So you cannot just sell something that you own where a fair market price is around 4,000 ETH. You cannot just sell it for 4 and the bank, if you're a retail customer, just executes the transaction and say, well, that's it. And then coverage restrictions. And this is important. And this is where also a lot of tension is, obviously, because the one way of keeping people safe is simply not allowing them to operate in these markets. But this also means that you don't have a chance to partake in the game. So that's not a great idea either. And then finally, the third area that I want to say is like market structure. And that's all the stuff about, okay, make sure the markets are safe, make sure the markets are operating, especially addressing information asymmetry. So things like insider trading, for example, but also generally people get information all at the same time. So there is, if you have information on a prospectus, everyone needs to have the prospectus ahead of time. Also things like safety of execution. If you submit an order, then this order should not just fall over. Definitely an order shouldn't be executed just one leg and the other leg isn't executed, and these kind of things. And also competition between providers. You want to make sure that the markets are relatively safe. And given that we're already quite a bit in, a little bit of advertisement for my book. If you're interested in there, I wrote a whole book on regulations on fintech, not crypto specifically, where I go much more into these details. Now, as I say, it is fintech. It's a few years old by now, but things haven't changed that much. But the same regulations apply. And now, assuming there are either a few people from the EU here, or also just simply because the EU is actually the biggest consistently regulated financial service area in the world, I always think it's actually quite good to understand the EU regulatory framework, because that's a relatively consistent framework. Other areas are similar, but for example, in the US, obviously the US is a much bigger financial market than the EU. It's roughly the same number of people, but financial markets in the US are much deeper. But in the US, the markets are much less integrated. I mean, try to make a bank transfer in the US between different states. You're going to have fun. I mean, they introduced chip and pin, 2 years ago? And in France, chip and pin was around 15 years probably now. More actually. So the EU has now a relatively nice regulatory set. I mean, nice depends on what you see as nice. It is a consistent framework, so it's worth knowing, and it's a framework that they export. These things are always, when markets are international, ultimately you follow the big boys in regulation. The big boys are obviously on the one hand the US, and on the other hand pretty much the EU, and China is doing a little bit their own thing. So the key regulations there that you probably, if ever you're in this area, you should have heard about is MiFID, Markets and Financial Instruments Directive. And the key area there is really, it tells you in the EU what is a financial instrument. In the US, you have the Howey test. The Howey test is a bit of a nightmare, and it's effectively everything in crypto is a financial instrument. And the EU is much nicer there. So they essentially define a financial instrument in the appendix of MiFID. And well, if it's not in there, it's not a financial instrument, which means a lot of tokens that would be financial instruments in the US are actually not financial instruments in the EU. And by the way, a stablecoin is not a financial instrument generally. I mean, if it's a bond or whatever, it would be, but currencies are not financial instruments. People sometimes get this wrong. There's sort of different requirements for currencies than there are for financial instruments. Capital Requirements Directive, that's about banks. The interesting part there is that effectively the US equivalent of this, and Capital Requirements Directive is really Basel I, Basel II, Basel III. So that's a very international regulation. That's effectively the one that is going to be important for stablecoin issuers. And this is probably one of the most complex regulations in this space. So that's a bit of a pain if you have to follow those. PSD, Payment Services Directive. That's about payment institutions, payments providers, which, by the way, could also be a regulatory form possibly for stablecoin issuers. The interesting area there is that's where open banking happens. So all these banks need to have APIs, and you need to be able to connect to their APIs. And this is where traditional banking moves closer to blockchain banking. But it also means that you possibly have some technology. It's not technology neutral, and blockchain solutions might actually run into issues with this, because if they assume that you need a REST API and you don't really have a REST API, but you use you use a blockchain RPC API, they might or might not. Sorry, I just have to wave that my light goes on again. You have a blockchain API. This might be a technology issue. E-money directive, electronic money directive. Now that is super important, because this actually doesn't really exist in the US, because this would really be the regulation that, in my view, is the best suited for stablecoin issues. That's the one really that you should use there, because e-money is exactly this: is you don't really hold money on other ways for other people, but you do all the infrastructure. The idea was like prepaid cards initially, but then you had the likes of Monzo and Revolut. When they started out, they all started out under e-money license. So that's quite an interesting license, because it's lightweight enough to be feasible, but it's actually also pretty safe. Prospectus regulation, it's another very heavy one, and obviously there's the equivalent in the US. Whenever you deal with tokens that are security tokens, i.e. tokens that are considered a financial instrument in the EU or a security in the US, then you need to file, you need to create a prospectus, and you need to file a prospectus. And prospectus can be pretty expensive because generally it's a legal document, so it's all written by lawyers, and lawyers are expensive. So that can be, it's not just, you don't just write a white paper or a short prospectus, you need to write a real prospectus. The interesting thing is there are actually some regulations that when you have like crowdfunding stuff, you can write a shorter prospectus. EMIR is about market infrastructure and regulations and reporting, which can be a little bit an issue for the likes of AMMs, for example, because if you consider an AMM be a market infrastructure, then they may or may not be able to report in the format that EMIR requires, depending on what the issues are. Also, EMIR has introduces a clearing requirement. So when you do derivatives, and again, so I haven't talked about derivative protocols, but if you do derivatives, they need to be cleared. Now, this is not an issue on blockchain, because cleared just means essentially fully collateralized. But fully collateralized, again, there might be technical issues that just simply the technology that the regulation assumes just not the same that blockchain does, and that's just sort of, it could be adopted, but it doesn't fit the world of things. AIFMD and UCITS, these are fund management. AIFMD is for hedge funds, UCITS is for mutual funds. CSDR, that's an interesting one. After the great financial crisis, regulators were like, oh, we can't see where our securities are. We need to have more transparency in the market. All securities need to be registered in a central securities depository. Now, the problem is in the name that the central securities depository is a central securities depository. And the way CSDR is written, a blockchain cannot really be a central securities depository. Now, a number of people are trying to get around this issue, and they're getting slowly but surely around this. But this is one of these examples where really regulation is really painful, because there is really no reason why a blockchain shouldn't be a securities register. It's just because when this regulation was written, no one was thinking about blockchains. And so the way it is written, it actually excludes blockchains, but not for good reasons. It just happens to be that it just doesn't work. And so this is one of these cases where regulation can really, really be annoying, because whilst in theory you can change it quite nicely, in practice it puts a lot of stumbling blocks in your way. And people have literally spent years and hundreds of thousands of legal fees to get around this for blockchain-based exchanges that can deal with security tokens. AMLD, Anti-Money Laundering Directive, extremely important. And because this is where, as I said before, that's sort of this policy support area. This is where it says that what you need to know about your customers, and obviously the whole point in crypto often is that you don't quite know your customers, you only know their crypto address. And this, by the way, is also in AMLD 5, which is sort of the latest installation of this. There's this licensing optionality / licensing requirement for VASPs, for virtual asset service providers. So that's where, for example, Germany has this mandatory. So if you have a custodial wallet, for example, in Germany, you need to register as a virtual asset service provider. And the regulatory framework for being a virtual asset service provider is AMLD 5 to be precise. And finally, GDPR, General Data Protection Regulations, which is, by the way, not the cookie directive. So GDPR is not what makes you click accept all whenever you visit a new website. That's a different one. But GDPR is about data privacy, it's about right to have your own data, right to have your data erased and stuff. And there are a few obvious issues that, again, you need to work through. Because things like you have the right to have your data erased is on an immutable blockchain, not that easy. Now you can possibly operate with hashes, but whether you're allowed to operate with hashes is not clear, etc., etc. So all a little bit complex. And yeah, sorry, this was a little bit of a tour de force on the things, but I hope I have given you a little bit of an idea how the concept of decentralized finance fit into the traditional world, and what the regulatory space, the regulatory umbrella is that you actually need to consider. And this is something that we need to work out over the next 2 to 5 years, let's say, because when DeFi grows, we need to have a convergence, because these regulations are there. They're not going to go away. They might be adapted for crypto, things like CSDR, but the regulators are not just going to lay back and say, okay, look, you don't have to do AML because you're a blockchain, and so we don't care. Yeah, so essentially this is where I am, and I guess now we are open for questions, which I haven't read, so I'm looking for the organizers to tell me a little bit about some of the questions that we want to discuss here.
No problem, Stefan. So I see 2 questions that are really relevant to what you were talking about. By the way, thank you for the presentation. Really interesting stuff. Regulation is absolutely an essential topic when it comes to blockchain and crypto. We appreciate your expertise. So first question, with decentralized stable coins, are regulations even enforceable?
Well, at which level? There is sort of, okay, so there is this thing like the corporate wheel, and this has been actually pretty useful when this was probably 1700, 1800, it has been for a long time, that you started having limited liability companies, because before that, generally companies were partnerships, and you had like every partner in the company had unlimited liability forever, whatever the company was doing. And this is obviously pretty annoying if you just have like whatever 5% share. I mean, whatever this means, 5% share, and then not in an unlimited company. But essentially, they had this concept of joint and several liability that effectively, if you have 5 partners, the people can go after everyone in this company. If there's sort of something happening, people can go after everyone in the company to do whatever they think needs to be done. And for stock markets to develop, etc., people develop the limited liability company, where when you put $100 in equity, all that you can lose is your $100 in equity, and people don't go after you for more as a shareholder. Now, stablecoin issuers, if you work on a stablecoin, there is always a theory of what is your liability there. And the worst case scenario is really that everyone who is involved there is joint and severally liable. So you can come after every developer, you can come after every promoter, you can come after everyone in this area, because if they haven't incorporated something as a foundation or as an LLC, then yeah, if this is not issued by a foundation or by an LLC, then if the regulator says, or it's not the regulator who says it, it's really the courts. If the courts say, okay, look, that's a partnership and it's not limited liability, and there is joint and several liability, then this can be a really bad problem for every single person that is involved in this area. Now, that's a very, very pessimistic reading of the state of affairs, but it doesn't mean that it cannot happen. It's not likely to happen, especially if regulators want stablecoins to go. But if you go really against the regulators, then this is one of the areas that people that people can go. And obviously, you can also do the other area where you can then where regulators can always go in, a stable coin that you cannot convert into fiat and that you cannot convert to into assets is also not particularly useful. And the interesting thing is that things like the AML, so for example, the AML requirements, they do not only apply to banks. So it's very clear. So if you get 100,000 in stable coins and regulators don't like stable coins, then the banks are just going to tell you, look, if the money comes from stable coins, you cannot bring it into the traditional banking system. But the thing is, in theory, you can't even buy a Lamborghini with it, because if you rock up at the car dealer and you show up with 100K in cash, actually 100K doesn't buy you a Lamborghini, but whatever you need for a Lamborghini. If you rock up with this in cash or in stable coins or in apes, then in theory, your car dealership is meant to report this to the central bank. And there is the central bank can then do whatever central banks do to establish who this is. So this was a long answer, but to say it's like, it is hard to regulate a stable coin. It's hard to regulate an algorithmic stable. Okay, and by the way, the other thing is obviously we're talking about algorithmic stable coins like DAI, and also even DAI. The problem with DAI is that the big DAI collateral now is USDC, and USDC is connected to the real banking system. So you can also hit DAI by hitting USDC, because you can just freeze the collateral assets that they have, and then the USDC is dead. Yeah, so that's how you can get stable coins that are collateralized off chain. You can always use a legal system to attack them. For if you have DAI backed by ETH, that might be a little bit harder. So that is a little bit more robust. Algorithmic stable coins are a little bit more robust in this area, but you can still outlaw their use, and it's going to be pretty hard to use them in polite society if the regulators don't agree with that.
Gotcha. Okay, so one more question. For US citizens, what would prevent us from utilizing a stablecoin that was established outside the United States?
Well, okay, clearly this is not legal advice, yeah, and I'm not that on top of the specific of regulations in the US, because they're really very specific. So here, my friend Stephen Pally would really be one of the guys who would know about these things in much more detail. The first thing is probably, if you're using a stablecoin outside the US, you're probably clicking through a banner that says, I am not a US citizen. So technically, you're probably committing fraud when you're doing this, because you're misrepresenting your legal status. Depending what the stable coin, and again, we need to now distinguish between stable coins that are sponsored and stable coins that are algorithmic or whatever, where no one controls these kind of things, and you just do whatever you do. I mean, if you have smart contract interaction, there's not very much that can do. But let's think about these, especially these stable coins, where we say they need to be issued by a bank. They need to be issued by a bank. Imagine the EU would do essentially the same. You almost certainly have to click through a banner where you say, okay, where am I from? And then, yeah, if you get more than 10,000, they probably have to do KYC on you. Yeah, 10,000 tends to be the limit under AML. So if you put more than 10,000 in ETH, they have to do KYC. If they can't cover the US for some reasons, they need to tell you, sorry, we can't do that. Or they do it and they say, look, I don't care about the US, but then possibly the executives can never travel to the US. Yeah, this happened to the in the gambling area, because a lot of gambling. So gambling generally was like also had these banners. We're not allowed to, if you're a US citizen, don't come here. But then some gambling places were a little bit less diligent in making sure that they really don't have a US citizen there. And for example, they still accepted payments from US credit cards, which is like, oh, I'm not a US citizen. I just happen to have a US credit card. And my postal address is where whatever, or I'm with, yeah. So where you say, look, they are probably US residents, especially if it's like 50% of your customers, then there's really possibly an issue there. And these people literally could not go to the US. I mean, there was, and I think there was one who was in transit in the US, on a US airport. He was just in transit there, and he was arrested and he went to jail in the US. I don't know quite what happened afterwards. And I mean, depending on where you're flying, maybe even if you don't think that you have to do a land in the US, maybe you have to do an emergency stop in the US, and then you end up in jail. Yeah. So that's sort of the thing. Sometimes you can get away with things, and sometimes you can't. So I guess that's sort of the US thing. Also, possibly good luck if you have to sue them for some reason. Yeah, if they somehow don't give you your money back or whatever. If they say, look, you're a US citizen, maybe you shouldn't have come with them in the first place. I mean, you probably can still sue them, but it's going to be harder for you if you initially clicked through and said, I'm not a US citizen, and this is clearly not the case.
Gotcha. Thank you, Stefan. This was really, really interesting and informative. I'll take the last few minutes of this hour to answer Metis specific questions, but we really appreciate your time. Check out IDCAP at idcap.org. Really, really interesting, educational, informative, and we will have more information about our partnership with IDCAP with respect to the hackathon as time goes on. Stefan, have a great day. Thank you so much.
Thank you. Bye.
All right, so we will take questions. Basically, our presentation on the Metis site is over because we're almost at the top of the hour. Hackathon.metis.io is obviously where you can find all the information. But I'll go ahead and answer questions right now on behalf of the Metis team. So let's see. First of all, question is, as nodes, as nodes are decentralized and full control may not be available to the project, how do we ensure security? Okay, so I will be happy to answer that question. Let me go to my notes here because I have made efforts to answer that question already. And this is from our tech team, by the way. This is our CTO, Yuan, as well as our tech evangelist, Pavel. So Yuan says, as always, by the community, rangers will be incentivized to verify transactions, and the network will self-heal from malicious actors via the peer network. Pavel gives a great answer as well. He says the lack of control is correlated with the security of the network. So security and decentralization, this is me talking, security and decentralization of Ethereum, they go hand in hand. That's the point. Because it's decentralized, it is secure. If you have a centralized network, a side chain, and so forth, some of our rivals are side chains, as a matter of fact, that creates security issues. The more decentralized it is, the more secure it is, because ultimately, you've got so many different people involved in the mix. Pablo goes on to say the architecture initially depends on decentralized verifiers, verifiers, as we mentioned, whose job is to make sure that all transactions that the sequencer posts are valid. Through decentralization, we ensure security. So there's the answer to your question. Here's another question. What plans does Metis have for development with the GameFi sector? Indeed, in my opinion, this is a very promising direction. We certainly agree. So we have already onboarded some GameFi projects, and we've got a couple of others coming down the pipe. We're in touch with them frequently. We love GameFi. We think it's so cool. It's very much in touch with the Metis DNA and our mission, which is to make blockchain accessible and beneficial to the world. So the idea that you've got, a 16-year-old in Indonesia playing a game and benefiting financially by reaching certain milestones, and you've got companies bridging that gap via NFT technology and gaming technology and DeFi technology, super cool. All of a sudden you can make a living, as a teenager who's just super into games. That's really, really fun. And it's something that we believe in. Aside from the fact that it's a hot sector, again, it really fits our mission of what Metis is trying to do. So we're all over GameFi. We're really going hard after it. We have recently grown the size of our biz dev team. I can assure you, I'm the head of biz dev. I can tell you this. We're going after GameFi. What else we got here? A large number of transactions in the Ethereum network await us with the moment of development of the gaming direction. Okay, this has already been answered. From a security perspective, what partners and technologies are we currently working on aside from the typical audits? So we will be announcing shortly, but I think I can, give a little tease here. So first of all, we're triple audited, right? So Armors Security, which is a great partner of ours, and we actually just spoke to Armors, as a matter of fact, right before this Zoom. They're great. Hacken and Slow Mist were the other auditors. So we were triple audited. Triple. That is not normal. We believe in security so much, it's like unhealthy. Pavel, who's our tech evangelist, I think he likes security more than ice cream. Honestly, I've never seen anybody smile that much over something so seemingly mundane, but it's everything to us. Decentralization and security are essential. Tomorrow, we will be having an article, by the way, that we will be publishing, which will talk about decentralization and security. Elena is jumping on, our CEO, so she obviously has something to say about this as well.
Yes, so I probably wanted to answer another questions, but yeah, John, thank you so much. I think you answered it pretty thoroughly. So let me jump to another one. Okay, will there be any constructors for building a dApp based on a hackathon for ordinary users, non-developers? Oh, it's a really good question, because this is exactly what we aim for with our middleware Polis. Right now, we're still in the development stage for it, but our vision is to onboard dApps without coding, so people can just, with the click of the button, can deploy the dApp of their own. In the meantime, though, we open a hackathon for the Solidity developers, and this is our first stage. So we're going to be later holding on hackathons for non-developers as we develop our middleware as well. Okay. And what dApps do developers release for the hackathon now? We actually started vetting right now the projects. And today we had a discussion with the team whether we push developers to uncover what they are developing or not, because they are very conscious of their deadlines. And because we set the deadline on November 30th, right? So we kind of right now in the debates, like whether we should ask them to submit early or we don't ask them to submit early. But yeah, we're going to be deciding that, and you're going to be hearing it from us, on Twitter and Telegram. So maybe we will just already uncover some of the hackathon participants and what they building on as well. So we just came back from the conference. We've been on ListCon. We also went to Blockchain Live. It's the largest European conference as well. One of the major milestones for us, we talked to Stani, our friend, and Avi. And he committed helping us onboarding Avi projects on Metis as well. So right now we're in the process of that. And I know that our hackathon developers, they actually would like to use Avi in their project. So that's why we're right now in this mode of working on Avi APIs so our hackathon developers can use it as well.
I'll take a moment, actually, because everybody's asking about Andromeda. Here's what I'm going to say. We are putting out a Medium post tomorrow. I'm editing it as we speak. It will have a lot of information about what we're doing, how we differentiate ourselves from other networks, which you will see because we're committed to decentralization. And yes, in the Medium post, which will be published tomorrow, we will unveil when we plan to launch Andromeda. Stay tuned. metisdao.medium.com is where you'll be able to read that post. We'll put it up on Telegram, Twitter, whatever. So whenever you ask and we say soon, or when we're ready, or when we've reached the highest standards of decentralization and security, yada, 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 you can say, okay, mark it on the calendar, whatever, and then you never have to ask us any more questions. No, I'm just kidding. Please ask us lots of questions, but yes, this Medium post will have that information.
Yeah, I would like to also take a moment and thanks the community for testing, because we were able to get about 600 people to test our DAC creation, and they did a really great job doing that and helping us. So thank you very much. And yeah, so we're going to be releasing the article about Andromeda, and then yeah, we're going to be coming out with all the announcement ahead of time. Also, what I wanted to, I think okay, so I have this question that I saw that caught my attention. Will the goal of this community be aimed of making the poor rich? Also, would it be a long-term project or just one of which whales would make millions then rug? All right. Yeah, so probably, I'm guessing whales already made the millions on these projects, and we're still there. We're not one of them, probably. Anyways, our goal, of course, for the long term, we have a huge vision of Web2, of helping Web2 projects to onboard onto blockchain with a click of a button. And of course, it requires from us lots of effort, lots of time, lots of development to reach that goal. And for making poor rich. So this is not that we are aiming for that. We position ourselves as a blockchain for everyone. So everyone using a decentralization can create their own decentralized company on blockchain. And that's what we are. We, of course, will be educating people, because we would like to have lots of nonprofits, charities on our platform. Of course, as well as, for-profit commerce businesses, that, and they come in first, but we would like to support those who we can help as well with that. And we're doing, and we are going into that direction too.
You had mentioned testing, by the way, Alina. So one thing which I think we can say is there will be one more round of testing, which we will open up by the end of this week. And the goal is, you'll see why in the Medium article. Things have happened architecturally, really, really positive things for us. But it gives us another opportunity to go through the Dragonfire testing, particularly as it relates to DAC formation and to staking. And we want to emphasize that the staking program is obviously exciting, the APYs are great or whatever. The goal ultimately of DAX is to build a hub for the entire Web3 economy. It's for thousands, tens of thousands, however many people and entities to form decentralized businesses on chain with extremely fast and cheap transactions on our layer 2 and build for the future. So the staking program is great and we're excited about it, but it will be temporary when we have our DAC infrastructure fully deployed, and I am calling it the Metis verse, and I don't care. That's what I'm, other people want to call it something different, fine. But that's what we will be doing for a while. But once we're fully out with our DAC staking activities will go over to a third-party DEX called NetSwap, which will deploy on our layer 2. So this is a great program, but it is not the sole purpose of DAX. DAX are ultimately building toward something way larger, way bigger than what any of our competitors are offering. Name them, none of them are as ambitious as we are, just so you know.
And then just to mention also lots of kind of competitors coming to us actually to build on Metis platform as well. Like lots of DAO infrastructures that are right now in the development, they actually come in into Metis because they see the value. So in the later days, we actually had meetings and signed contracts with those as well, and you will see the announcements. Would Metis plan on expanding to other network chains, the newer ones other than ETH, such as Thor chain? Yes, originally our big vision is to do it multi-chain, because DCs, DAOs, they can be on, regardless of what chain they are. We started working in that direction already, building the bridges. What we would like to do right now is develop the ecosystem, of course, on Ethereum. And this is something that we would like to focus, because lacking this focus can actually lose us, the success. So therefore, we're focusing on that first. And then we have a vision, yes, of course, to go across chain as well.
Well, and I think that's part of our overall strategy, right? It's just if you only built a layer two network, it's incredibly complicated, right? To create roll up technology and be able to scale a zillion transactions such that they come through cheap and fast and scalable is difficult. What we're proposing between that and building no code middleware with Polis and having IPFS on chain storage for cheap and having the DAC infrastructure, which is more ambitious than anybody else, it automatically necessitates us doing everything gradually. So when we say, okay, Andromeda, and then another launch, and another launch, and another launch, that's how it's going to look. So there's not going to be one day where we put everything out. Our dev team works constantly, and everything will occur in stages. So again, you'll see this in the article tomorrow, which will explain things a little better. But ultimately, the idea is this is a constant evolution. Our project intends to be here not for years to come, hopefully decades. We have community mining. Half of our entire token supply is reserved for community mining over the next 10 years. So we're not going anywhere. We will build and build and develop. And no matter how the industry changes, we will adapt and hopefully even be ahead of the curve. So we're innovating before other companies do. That's ultimately what we intend to do.
Okay, thank you. And I think we're a little bit already 6 minutes over time, and this is something that, yeah. But thank you so much for your questions, and I'm so glad to be back on the live stream. Thank you, John, today for leading live stream. Thank you so much, Stefan, for the presentation, for the excellent one. I was listening to it all, and I would like to thank our community.